Yeah. So let's start with it. Fine. Okay. So coming to management audit reports. So in the last session we saw the qualities of a management auditor. What are all the working papers, what is management audit, evidences that he got to have and stuff. So now coming to a management audit report. See, there is no specific format as we have in cost audit report. So management audit report is basically a request from the management, okay, and according to their requisition it is prepared. So thereby the format is not fixed, but to some extent it needs to adhere to certain characteristics which will make the management audit report an informative one and a it will solve the purpose for which it has been created. So while we look at the characteristics, see, it is the reflection of the quality of review performed in various areas. It's not like cost audit report, we have certain formats to be followed and it's easy to implement. It's not that way. So you have to really look into the purpose of management audit, and that will be the main motive behind how your management audit report will look like. So while we look at the characteristics of a good management audit report, first comes the pertinence, comprehensiveness, brevity, timeliness. It should not be like prolonged for a longer period of time. It should be restricted to a timeline. Motivating, appropriate, and database to support the outcome. Database. How have you come to a conclusion? So often these reports are labeled as exception report. Okay. So the deviation from the laid down processes, unauthorized activities, performance deterioration, value destructions are actually dealt in these reports. And then benchmarking of activities, that is you go in comparison with the benchmarks, industrial reputational risk system, control where are all the lapses that has happened. All these needs to be addressed. So the top policy executive is generally interested in 4 factors in operating statements. What are those 4 factors? First one is the facts, that is your conclusion or your suggestion should be based on facts and data. The person responsible and deviation in actual performance from the standards. So you say the deviation, but if it is expressed in a measurable quantity, then it is much easier for the management to understand how far the deviation has occurred. And the effect of the result, not just the deviation, but the impact needs to be explained. The facts, the person who is responsible for this, and the deviations in actual performance from the standards, and the impact, both financially as well as physically, what is the status of the organization due to such deviation. And what should the report do? It should allow the management to, or it should facilitate the comparison, review the organization and appraise the effectiveness of the executives. So it should be helpful in that. And it should create awareness among the management of prudent management practice that can make the organization come alive. That means you are going to give really good suggestions that is actually good for the management to work on. Then, well, coming to the contents of the report, what is that which is expected out of you? First one, all the endeavors of the management auditor are epitomized in the report he renders finally to the management. So whatever insight, experience, whatever is his professional expertise, wisdom and all those things are put together in the report. Okay, so in writing the report, the need of the recipient of the reader should be clear and total understanding should be there and must receive priority over all other considerations. The second one, that is the report rendered by the auditor, how far it is simple, okay? Simplicity, brevity, completeness, all these things are necessary. Okay, so that which is ambiguous in the sense it's not to the point, or it says it could be there or it may or may not happen. So it should be with certainty, it should be to the point, and it should actually not beat around the bush. It should be directly to the point. And what are the things, the way it should be looked at? First one, planning the report. So it is advisable to wait till the audit is completed. Arrangement is careful thought in necessary in arranging the matter. That is the flow of information. How are you going to present it? Last will be the conclusion decision. First will be what has been observed. What is the deviation? Okay. Then selection of meaningful data. Of course, use of paragraphs, headings, all these will help the management to easily go through it, and the recommendations at last. So all these things should be there in the management audit report. So as I told, there is no strict standard format for management audit report, but still if you have some standards in place, it is better that is being used. Why is such standardization? Because there can be many management auditors who are actually working on it. So a report of a different format every time will also be misleading. So you can have a standard template which can be used by most of the auditors in drafting and writing the report. Secondly, it facilitates reading by most recipients because they'll be accustomed to that format. So format, though it is not given by any act or anything, but see to it that it is in a standard format. So it is intended that the report will be accompanied by a brief letter. So what are the things that needs to be in the letter? First one is the title, that is the name of the organization, period for which it is covered, the dates of the audit, the details of the auditor. This is the title. Table of contents. It should have the captions of parts, major sections, appendices, all those things. Summaries of conclusion, body of the report, that is details in support of each of the findings. Appendices should have the supplementary and supporting information, that is in the form of table, graphs, charts, etc. So there are also special reports that are being prepared for banks, shareholders, employees and small businesses. So this will also serve the purpose. So sometimes the reports have to be prepared and submitted for special persons or purposes. Like for example, if you are going for a bank loan, bank credit, then the form and content of financial statements, schedules are important to the lender, but explanatory notes are also more important to them because they will look into those things. Like for example, if there is some contingent liability that is going to arise, okay, that needs to be mentioned explicitly. Those are all the footnotes of the final statements, which is very important for the lenders actually. So in case if the contingent liability arises, how is the company going to tackle it, or what is an liability which they foresee in future? Because all this is going to actually affect the repayment of interest, repayment of principal and payment of interest on time. So therefore, depending upon the user of the report, the data should be populated in such a way that it makes sense to the user. Fine. So you also need to understand to whom it is addressed to. For example, for bankers, banks and creditors, they'll be much interested in the efficiency of the business, financial position of the business, which will actually help to know whether the business or the company will be able to repay the principal amount of the money borrowed and the interest on time. So looking at that purpose, whatever is important information relating to it needs to be populated in the management audit report. Then coming to report to shareholders. So shareholders will be much interested in not just profits but also the growth of the company. So what are all the things that you need to include in it? For example, the report is read by financial experts, bankers, tax authorities, public officials and research people. If you look at the report that is shared to the shareholders. So there should be analytical details, full facts about the organization's business, okay? And in India, an auditor's report is the prospectus at the time of public issue is very important, okay? So experts read between the lines of the auditor's report, so it will ultimately reflect in the auditor. Then coming to employees, of course employees will be worried about, they have things to understand about the company, how is it going, or there should not be misconceptions that the report should carry, okay? So it should be mainly made to understand the business properly. So what will it help in? So it will try to avoid strikes, okay? So will there be any strikes, labor strikes? Is there any competition or competitors for this, okay? So the report to the employees, how it should be. They should gain confidence on the company for which they are contributing. So that confidence, so the report should be unbiased, okay? So whatever is the truth, whatever is the condition of that particular company should be properly reported. Then reports for small businesses. So for small businesses, they have less of the systems, okay, less resources, and at the same time they cannot go in comparison with big companies. So the report should be in a very simple manner. It should be given to the small group of persons, and at the same time it should not be, see to it the reporting is not very subjective due to inadequate data, okay? So all these things to be kept in mind and needs, while preparing reports for the small businesses. So depending upon the audience for the management audit report, the report shall be prepared accordingly. Fine. So while moving on to the next section of this topic is management, reporting issues and analysis. This is very interesting because we will have few problems to do. We'll be recollecting a lot of ratios that we have learned, okay? And how this analysis is actually going to help the management. Fine. So first comes the performance analysis, okay? Reporting is nothing but communication of communication of information between the parties, two parties. But when this communication happens to the management, then it becomes management reporting. So while we look at the purpose, okay, so it is the purpose based on which the reports are generally prepared. So the distinguished function of management audit is there in the organization to help the management in taking the right decision at the right time, okay. The second one is timely flagging to notice whether the management is able to achieve the goals or not. So it is going to actually push the management towards it. Another thing is management audit reports are analytical in nature. So data collected from the database which is maintained by the company, IT department actually. So it will help in decision making process. So actually when we look at ERPs, the big ERPs, right? So wherein according to the requirement of the company, customization of reports, such customization of reports can be requested to the IT team and they can customize those reports in the system. So with the click of a button, it will gather the information and give you the data. So such reports can also be prepared, but it is not possible in small kind of ERPs. The big ones like SAP, BAN and all those things, they customize the reports itself according to the management of the company's requirement. So that is possible. So that's called ERP based reports. Okay, so management carries out process improvement reviews also, and for the sake of smooth operational flow and cost reduction, ERP based reports are suggested. For example, truck-wise turnaround time. So it actually, what does it do? It keeps monitoring the trucks, okay, from where to where it goes, from where it comes back, the transit time that it takes, what is the availability of a truck for transportation of certain goods, okay. So all these things are captured by this system, or even a simple app can do that for you. So accordingly, fixed cost incurred by the truckers will be reduced when compared with number of trips and a percentage of the same. If passed on to the company, the transportation rate can be reduced. So see here, with this implementation of app, it becomes easier to actually control the transportation cost, so that there are no idle trucks and trucks are being properly utilized, okay. So this will actually help in. So when it comes to using technology in all such cases, will actually help in monitoring at a micro level, okay. Even a single move of the truck can be tracked through. So such apps are there which is used to actually track the trucks wherein they are available for transportation. And depending upon the organizational hierarchy, the management audit report also vary in length. For example, if it is a topmost hierarchy, what will they expect? It should be to the point, it should be brief enough, it should be crisp, it should be giving the suggestions at one shot. But when it comes to middle or junior level, a lot of detailing will happen. So that is what, depending upon the audience, it's not just the external but also internally, to whom the report is going to go, it should serve the purpose. Then at times it also handles special assignments, the scope of which varies according to the assignment. So it is basically based on ad hoc basis. It's not something that is permanent in nature. So as and when the situation arises, you may be asked to prepare the report accordingly. Fine. So this is all about the management reporting. Then coming to the features of management reports. What are all the things that can form part of the reports that are actually prepared? One is the financial reports, like the cash flows reports, borrowing versus cost of borrowing, performance versus budget. So these are all financial reports, which is going to compare across different time period. It will be financial in nature. Then coming to information reports. Information reports is the trend of different activities, like the trend reports, analytical reports, activity reports. So these reports can be segment wise, okay. So it will give the information. Then control reports. So what are the control areas? Where are these control effective or not? So the performance of each responsibility center, periodically how it is going on. So it is monitoring and reporting on the controls that exist in an organization. So these are the characteristics of management reports. Well, coming to reports based on nature. So there could be a classification based on nature. First being enterprise reports. Enterprise reports is the overall report of an organization. So operational activities, the financial position, these things. So these enterprise reports are especially useful for the external users, such as bankers, financial institutions, shareholders, they use them. Then we have investigative reports. This is ad hoc basis, if something needs to be investigated. So it is specifically prepared for a set of people for a purpose, for actually pinpointing or for actually highlighting a particular problem. Then coming to based on functional classification. So previous one was the by nature. Now it is by function. So we have individual activity report, that is for a single department. Joint activity reports is for like a project department which is having lot of things going under it, okay, and how a particular activity is going to affect another activity and its impact on the overall completion of the project. So that is joint activity report. Fine. So while we look at, so these are different kinds of management audit reports. While we look at the performance analysis, this is very interesting as far as performance analysis is concerned. So how do we analyze the performance and why do we do that? Okay. So what's included? The parameters against which the performance needs to be measured. So one is called benchmarking, so comparison with the benchmarks. Another is called the measuring the yardstick. Okay. Even you can say key performance indicators, KPIs. Okay. So measurement of the actual delivery. So all these is basically the performance analysis, how far the business is able to achieve its organizational goals is what is part of performance analysis. Okay, so there are different parameters. Then coming to capacity utilization analysis. This is very important because in costing always we look at capacity utilization and to aim at 100% capacity utilization, but practically it doesn't happen. But how is this capacity utilization is gauged? It is gauged as actual level of output divided by the maximum level of output into 100. So this capacity utilization when expressed in percentage gives an idea as to how far the assets have been utilized by the company and what are the root causes for underutilization. So if you target the root causes, there could be some which are within control and which are beyond control. If it is something within our control, within the management's control or organization's control, that can be targeted and the efficiency can be improved upon. So like for example, XYZ company is producing 20,000. Maximum it can produce 40,000 units. That means it is at 50% capacity utilization. So my question to you is, capacity utilization when it is less, right? So is that going to elevate your variable cost per unit or fixed cost per unit? What do you think? Yes? You can unmute and let me know. So is that going to have an impact on variable cost or fixed cost?
I think variable only because
Sorry, can you be a bit louder?
I think that variable only because for fixed cost it is for all the capacities it is same, na?
Still it's not audible for me. It's very low as such. Fine. You can even write it in the WhatsApp. You can put it in the chat WhatsApp. So if you have anything, you can put it here in the chat box. So basically, when the capacity utilization is going to be affected, right? Yeah, can you just type in whatever is your comments? So it has an impact, bearing impact on fixed cost. Okay. So when the asset is not properly utilized, the production units comes down and the fixed cost will be shared across less number of units. So your fixed cost per unit is actually going to go up. Fine. So if you look, advantages of better or higher capacity utilization is better utilization of the resources. C. Reduced per unit fixed cost of product. So this is what I was looking for. So because variable cost is going to vary according to the number of units produced. So per unit it's going to remain same. But the total is going to change according to the volume of production. But whereas fixed cost, the total is fixed. But when you come to the per unit cost, it is divided by the total number of units produced. So if the total number of units produced is less, then your fixed cost per unit is going to go up. So thereby your costing of the product is obviously going to go up. So that is why the utilization, the capacity utilization has a bearing impact on the fixed cost per unit. And also, while we do economics and all these things, and we know that there is always a limiting factor that we have learned in our while doing marginal costing. The limiting factor can be any of the resources. It could be raw materials, it could be labor, right? So the limiting factors needs to be utilized properly. That is also one of the impact of capacity utilization. For lower capacity utilization, corrective actions may be taken. So that is those which are within the control. For example, if there is a machine breakdown, what you got to do? You should have proper maintenance in place, proper engineering team to support, repair and maintenance teams to support, so that the breakdown hours is reduced. If there is a power shutdown, then you can have a power backup to take care of it. Losing market shares, so then you have to improve your research and development, then you have to improve your marketing strategies to penetrate the markets, then advertising and sales, right? So these are certain things which can be internally worked upon, and that can give you a good result. Okay. Non-availability of key raw materials. So either you find out the substitutes, develop new vendor network, okay, and then non-availability of electricity, you go for renewable sources of energy like solar, wind and other things. So these are all the way the capacity utilization can be improved upon. Fine. Then coming to productivity and efficiency analysis. Okay. Just a minute, I'll just sip some water. Give me a second. So that is, hello, yeah, that is called production possibility frontier, which is in short known as PPF. It's not Public Provident Fund. What does this frontier speak about? So when you have two products to produce, both utilize the same raw materials, and that raw materials is scarce enough, then how are you going to plan your production for those two products? One limitation of PPF is it's a two-dimensional one which talks about only two products. Fine. So there is a frontier which is formed which gives you a combination wherein you can do a maximum utilization of the raw materials to produce two different products. So I'll show you the graph instant which will give you a good idea. Okay, just give me a second. So I'll just show you the graph. This is actually, it is used in economics, fine. So it is at the national, like from the economy level, like when you are going to measure national income, okay, from the economy level, wherein there are utilization of resources, okay. So when we look at production profitability, right? So I'll just, production possibility frontier. So see, this is how it looks like. This is the graph, okay. If you see, there are just two products. For example, x-axis is showing product B, which is cotton. Y-axis is the one that is showing product A, wine. But I don't know what cotton and wine has something to do in common, but it's just an example. So if you look at production of wine and cotton, there are different combinations that are formed here based on the availability of resources, which is commonly used by both of them. So this forms the boundary. So this will give you a combination of how many liters of wine and how many kgs or bales of cotton can be produced. So it is a combination of two things. So when we look at the combination of two things, a frontier is formed. So how do you actually choose? For example, if the market demand for wine is more than that of cotton, then you will obviously start producing more of wine than of cotton. So here if you see here, see, cotton production is less, whereas wine production is more. So if you plot this in the graph, this forms a boundary. That boundary is called the frontier. So these are all the different points of production possibilities of these two products. So if a point lies under this production possibility frontier, that is lower capacity utilization, that is you are not utilizing, that is not an optimal utilization of resources. If it is above the frontier, okay, so that means optimal utilization is possible and this PPF will tend to shift outwards. So this is what is production possibility frontier. So what I will do is I'll just share this thing on WhatsApp, this particular article, which will give you a very good idea about production possibility frontier. Fine. Then coming to productive versus allocative efficiency. So we were talking about capacity utilization. Now we are going to talk about productive efficiency, allocative efficiency. What is productive efficiency? That is maximum output out of the scarce resource. So how well the scarce resources can be used in order to increase your output. So what happened? The production of any additional unit result in opportunity cost, one which is reduced output of another product. This metric focuses entirely on monetary cost and resources. But whereas allocative efficiency means the distribution of goods and services. This doesn't talk about the production, this talks about distribution of goods and services. So allocative efficiency is a state of market equilibrium where both producer and the consumer, both of them benefit out of it. That is, from the producer point of view, the marginal cost of production is what we are looking into, that is the variable cost of production. But when it comes to the consumer, he is able to get a value for money, that is, he is paying lesser price or an optimal price for the product. So in this situation, there is a win-win situation for both consumer as well as the producer. So that is what is called allocative efficiency. So it looks into the distribution of goods and services. Whereas productive efficiency is the maximum output of product with scarce resources. I could say these scarce resources are nothing but your limiting factor that we usually go through in our marginal costing, right? Then coming to productivity and efficiency analysis. How do we do the analysis? Productivity, efficiency, so it's basically input-output ratio. What is my input raw materials that is going in and what is my final product that I am getting out? So less input per unit of output. More output with the same input. Much more output with relatively less increased output. Slightly less output with much less input. So these are all nothing but your input-output ratio. So often raw material cost component, electricity, steam cost component or the major cost component of company or industry. If you remember, while we were doing cost audit report, okay, so there is a separate annexures on cost of utilities, because utilities, first comes the raw material, next comes the utilities, then comes the labor. So usually these are the major chunk of cost where the companies actually incur it for production. So all these are looked into this input-output ratio. Fine. So raw materials, explore the possibility of using the superior raw materials. Superior raw materials will give you more of output with less number of input itself. Like for example, if the sugarcane quality is good, then the quality of sugar is going to improve on it. And explore the new vendors, that is in order to get competitive prices. Then purchase of raw material should be the list of approved vendors to ensure the quality, because if the quality is going to suffer at the input level, then obviously your output will be suffering from the same. So the quality of input is very important. Then coming to avoid emergency purchases, that is proper inventory management is important. Like having EOQ in place, that is economic order quantity, and have some safe level of safety stocks, to have safety stocks in place, and avoid any emergency purchase, because in case of emergency purchase you are not there to decide about the prices. So taking the advantage of your situation, higher prices could be quoted. Okay, and to maintain plant and machinery in proper condition in order to avoid breakdown. Then coming to electricity, efficient utilization of electricity, possibility that can be explored to use variable frequency drive on motors, blowers, etc. to adjust the load of machine as per process requirements. Then possibility can be explored to have modification of plants. So these are some technical levels wherein power saving is actually looked into. Plant should run at optimum capacity, and suggestions can be invited from employees on shop floors, because they are the people who actually work. So they have a lot of ideas too. So we got to voice out such suggestions. Then coming to steam, how do we reduce the process cycle time, reducing the kettle hours, reduce transmission losses. So in cost audit we actually studied something called enthalpy value of the steam, that is the steam escaping from the turbine, which is low in pressure. Okay, so suggestions can be invited from employees who are working on shop floors. So this was all about capacity utilization, productivity and efficiency analysis. So next comes utilities and energy efficiency analysis. So what is basically utilities and energy efficiency looks into? See, now energy is one of the important sector and which is very well required for the production. So how efficiently energy is utilized, and what is the form of energy, whether it is renewable or non-renewable sources of energy, is going to have a very, it is not only going to have the impact on the cost, but also now when we are talking about green energy, green finance, that's being the term, right? So the carbon emissions that is going to happen from the manufacturing plant is also looked into. Okay, so there are certain energy audits going on. What source of energy is being used? Because the carbon dioxide that is emitted into the environment is actually going to have an impact on the climate. Okay, so we have the, what is that? Climate impact, yes. So these are important from the perspective of not only from the cost perspective but also the impact on the environment. Okay, so that is what is all about utilities and energy efficiency analysis. So shall we take a quick break? Yes, because I cannot continuously speak because of my throat infection. Yes, so we will take a 10 minutes break and then get back to the topic again. Yeah. Hello. Yes, Anu, are you back from the break? Can you unmute and answer me? I just changed the settings.
Yes, ma'am.
Yeah, now I am able to hear better. Okay. So after going through this energy efficiency thing, we will do problems, which will be much interesting. Okay. So as I told, okay, so utilities and energy efficiency analysis. So it plays an important role as to. So what are the things a manager auditor will look into? First comes energy generated per unit of fuel consumed or fuel consumed per unit of energy generated for electricity generated, steam generated. Okay, so like in case of sugar industry, they have a cogen unit which actually generates from the bagasse, the steam is generated. From the bagasse, through the boilers, the steam is generated. Then this steam it gets into the turbine and electricity is generated. Okay, so how is that per unit of energy? Per unit of fuel consumed, energy generated per unit of fuel consumed. Then trend analysis of energy cost as a percentage of product cost. That is one important way to find out how far or what are the important costs that is adding up to your product cost. So as I told, first comes the raw material, then labor, excuse me. Then of course we have utilities. So energy power is part of utilities. Then possibility of recycling of commonly used materials such as paper, glass, plastics and aluminum, that will result in high reductions in energy usage and carbon dioxide emissions. Then better capacity utilization, that is what is by improving the input-output ratio. Then replacing the existing plant and machinery with new energy efficient. So we have done an interval, we do the cost benefit analysis. Okay, so you are going to save something on power, but of course it's a cost intensive measure. But it's a one-time cost that you got to invest so that you are going to save energy over the period of life of that particular asset. But of course it's a tough decision to actually replace a plant and machinery because it's a part of your capital budgeting decision, which needs to be carefully planned and executed, and it's highly capital intensive in nature. And possibility can also be explored to have modification of pumps, can be explored to use variable frequency drive on the motors, blowers, etc. So this will make it more energy efficient, that is, which makes it less on consumption side of power, and replacing the inefficient electric motors. So efficiency of the motors also needs to be gauged across a period of time, that is, the efficiency of the engines do come down, alright, so that needs to be changed. So redesigning the piping system to optimize the fluid flow, replacing older, oversized and inefficient pumps. Actually these pumps, what they do, they consume lot of energy but the output is very less. So in turn the cost, it will be higher on the energy cost and lower on the output. So energy savings is one of the important thing that needs to be looked into. Fine. So that way now energy is not like you can totally ignore it. It is important part of manufacturing kind of industry and even for the service industries. Okay. And then moving on to key cost and contribution analysis. So these are the techniques like profit volume chart, break-even point calculation, asset losses, all this can be gauged, and this is part of your key cost and contribution analysis. So these are all the ratios basically. So while we work on problems, that will be more, that will be more interesting. Well, coming to profitability analysis, so you already know these indexes like calculating the cost of goods sold, calculating the sales to stock ratio, calculating the gross margin, that is gross profit by sales into 100, Okay, so profitability analysis could be done on all these things. That is sales revenue, raw material cost. So why do you do the profitability analysis on sales revenue? Sales revenue in order to increase the sales. Sales is basically your operational revenue. Then why do you do on raw material cost that of profitability? So wherein it will help you to monitor, control and reduce the raw material cost. Because while you look at revenue percentages, it should be higher on the side. While you look at the cost percentages, it should be lower on the side. So that is why sales revenue percentage, it should increase. Whereas raw material cost, when compared to profit, it should reduce. See, utility cost, it is a cost. So it should be monitored, controlled and reduced. Looking at contribution, is that a revenue factor or a cost factor? You can unmute and tell me because I am able to hear you. So when it comes to contribution, is that a revenue factor or a cost factor? Yes?
Revenue.
Yeah. So if it is going to be revenue factor, it should be on the increasing side. Fixed cost, it's a cost factor. So once again, optimum capacity utilization so that the fixed cost per unit is getting reduced. Then profitability, of course, it's on the revenue side and it needs to increase. So what we will do a problem, fine. So I'll tell you the page number 462. And all these things have working capital ratios. We have already worked on working capital ratios. For sure 10 marks question you get it from ratios. Okay, so we have already worked out from the previous year question papers, if you remember. So let's do this problem. This is very interesting. Just a minute. So we have a lot of, we did the first question. Oh no, where is this? This is page number, it says 461, but there are so many things in the books. Yeah, coming to illustration 2. Let's do this problem. Yes. So illustration 2, ABC company has 2 departments producing small electrical goods. New technology for the production of X will induce the following cost. What is the cost that is expected? So department A, department B, both put together, whatever is the amount, that will be per unit cost for producing 1 unit of electrical good, because it has to go through these 2 departments. So if you look at direct material, we have 240 rupees for department A and 200 for department D. Put together it is 440 rupees per unit. Value look at to direct labor rate per hour is 120 and 100. And how many direct labor hours are consumed in department A and B? 2 and 3 hours respectively. So if you look at department A, it is 120 into 2, 240 rupees per hour. 240 rupees per unit electrical good that you need to produce. It will be 240 and over here it is 300. So both put together it is 540 rupees. That will come as direct labor cost. Fine. Then moving on to variable overhead per hour. So we have 50 and 30, which is variable overhead per hour. But we don't know how many hours it is required to produce. Right? So how many labor hours is employed, the same will be applicable to it. So 50 into 2, 100 rupees is the variable overhead. 30 into 3, 90 rupees is the variable overhead. So put together it is 190 rupees per unit. Well, looking into the fixed per hour based on 100% capacity, it is rupees 60 for department A and rupees 40 for department B. This is for 100% capacity. Okay, so you should be very careful about the 100% capacity parameter. So these are all variable: direct material, direct labor, variable overhead. Fixed per hour, we have to look at the capacity level. Value of the machine on revaluation. So this might be a part of your capital employed or capital investment. Well, you are going to work on it. So it is 40 lakhs for department A and 28 lakhs for department B. New technology cost is 25 lakhs. So which is your additional investment. Working capital, that is to run that particular technology, 7 lakhs is expected. So if you look at the investment that you are going to make is 40 plus 28 plus 25 plus 7 lakhs. Put together is your investment. The target volume of production in the first year is 2000 units, which is at 25% capacity. If 25% capacity is 2000 units, then what is your 100% capacity? Yes, can you do a calculation? 1/4 is 2000. So entire 100% is going to be 8000 units. Okay. Variable selling and distribution cost is rupees 3 lakhs for 2000 units. So while we look at the variable cost, this variable selling and distribution cost should also be included. So while that needs to be included, it is nothing but 3 lakhs for 2000 units. So per unit will be 3 lakhs divided by 2000, 150 rupees. Expected return on investment is 24%. So what is your expected return on investment? So the investment that we were talking about, 40 plus 28 plus, so for the entire thing to happen, right, it is 40 plus 28 plus 25 plus 7. On this you are expecting 24% return, which is 24 lakhs is the return that is expected, return on investment. Suggest the pricing of a new product for a new one or the existing one at 80% capacity. So value go for a new one, right? The return that you are expecting is 24 lakhs. Apart from that, what is the cost? So cost plus the return should be the price. Cost is nothing but your cost of goods sold plus return on investment is your profit. COGS, it is actually, we are having even variable selling and distribution sales. So we say COS, cost of sales plus profit is equal to the price, which is the selling price. So 24 lakhs, you know very well, is the expected return. But what about the cost? So let's calculate cost per unit, that is the variable cost per unit. Okay. So let me just put it in a table, or I can directly refer to the sum itself. Okay. So here if you see, so we discussed all these things. 240 plus 200, 440, direct labor 240 plus 300, that is 120 into 2, 100 into 3, 540. Variable overheads 50 into 2, 30 into 3, so totally 190. Variable selling and distribution cost is actually 3 lakhs for 2000 units. So 3 lakhs divided by 2000, which is 150 rupees. So as far as variable cost per unit is concerned, it is rupees 1320. So did you understand, Anu? Yes? Clear till here?
Yes, ma'am.
Yeah.
Yes.
Now coming to 100% capacity, we are going to target at 80% capacity. But for 100% capacity, if you say fixed per hour based on 100% capacity is 60 rupees and 40 rupees. So how is that going to work? Okay. So 60 into 80% capacity is nothing but 6,400 units. Alright. So 60 into based on 100% capacity is 60 rupees and 40 rupees. Yes. So 80% capacity, you have 2 hours over here and 3 hours over here. So 2 is to 3 if I am going to split. So so it is per hour. So 60 into 2, 120, and 40 into 3 is 120. 120 plus 120 is 240. Yes, 2,40,000. But what is the present level of the first year is 2,000 units at 25% capacity. How did they calculate this 16 and 24,000? Expected return is what we calculated, it is 24 lakhs. But while coming to fixed cost, yeah, so it is 8,000 units, so 8,000 into 2 is 16,000 and 8,000 into 3 is 24,000, so 8,000 into 2 into 60, that is directly 60 into 2 120, 120 into 8,000. If we go by that, it will be much easier. 40 into 3 is 120, 120 into 8,000. So that will give you 19.2 lakhs, which is part of your fixed cost. Okay. So while we look at the our cost, the cost of sales, it has variable cost, it has fixed cost. This is the total cost per unit. So here we have variable cost at per unit level, which is 1,320. But we don't have fixed cost per unit. We have the total fixed cost, which is 19.2 lakhs. Alright? Because this fixed cost is calculated at 100% capacity. Always you should be careful. Please calculate the total fixed cost and then divide by the number of units. That is the thing that you need to note down. Then coming to the return. Return is also the total return that is expected. So that is why 19.2 lakhs plus 24 lakhs put together upon how many units? We are at 80% capacity, 6,400 units. So it comes to expectation of 675 rupees per unit that we are going to produce. But this 675 is part of the expected revenue, that is the return on investment, and the fixed cost that needs to be recovered from the number of units produced. That is 675. Apart from that, for these 6,400 units, the variable cost per unit, which comprises of direct material, direct labor, variable overhead, variable selling and distribution cost, together is 1,320. So 1,320 plus 675 is 1,995, which is the price that needs to be charged. Are you able to understand, Anu? Yes?
Yes, ma'am, clear.
Any doubts? So this is going to be the price. So see what is the impact of fixed cost on per unit. If it is 19,20,000 divided by entire 8,000 units, it is going to be per unit will be less. See, 19.2 divided by 8,000 and 19.2 divided by 6,400. That is, I would say 19 lakhs 20,000. That will be better. See, 60 rupees, there is a difference. So that is why capacity utilization and fixed cost has a bearing impact, or capacity utilization has an impact on the fixed cost per unit that of production. It is clearly visible from here. Got it? Any doubts? So you need not, you don't want me to work it out, right? It's very simple and straightforward. Yes?
Yes, ma'am. Please.
Okay. Even then I am not able to hear much. I have increased the volume. The volume is full. Okay. So then let's look into another example which talks about the different ratios. So you can expect a 10 marks question. We have already worked from the previous year question papers, a lot of ratio analysis stuff. So it is like once again revision of your ratio analysis and the formulas that you have done in your financial management paper in Inter. So here ABC company has planned for an investment of rupees 800 lakhs, and this 800 lakhs with a 50% loan from banks at 10% interest. So basically this is debt and equity proportion that they are talking about. 800 lakhs with a 50% loan from banks, but that is going to come with an interest of 10%. Direct cost for the year is 480 lakhs, 50% of which is material cost. So 480 may 50%, that comes to 240. Other expenses are at 80 lakhs. Okay, so 240 plus 80, 320. The goods will be sold at 150% of the direct cost. So sales value will be 150% of 480 lakhs. The tax rate is assumed at 50%. Determine the net profit margin, return on assets, okay, assets turnover, that is nothing but your assets turnover ratio, return on owner's equity, inventory turnover ratio. So for inventory turnover we need cost of goods sold and not sales, divided by the average stock. Fine. So how are we going to do this when we have lot of things in bits and pieces? So first one that they are talking about is they have planned an investment of 800 lakhs with 50% loan from banks. That means 400 lakhs is going to be from the equity share capital and 400 lakhs will be from your bank outside funds. Okay. So this equity will be helpful on our return on owner's equity. So let's go one by one. First comes the sales. What are they speaking about sales? Sales is going to be, the goods will be sold at, so it is the sales value which is 150% of the direct cost. So 480 may 150% is 720. And what is your direct cost? They have already given 480 lakhs. So that gives you gross profit margin. But you have a ratio to be calculated on net profit margin. So then you have to arrive at net profit. How are we going to arrive at? So from gross profit 240, what is the next thing? Of 50% of which is material cost, so 480 may 50%, 240. Other expenses are 80 lakhs, so 240 plus 80, 320. 320 and 480, right? So direct cost is 480. So if you look at interest, what is the interest that they are talking about? 10% interest on 400 lakhs. Okay, so that we got to calculate. %, on 400, 40. 40 plus 80 lakhs is other expenses, operating expenses. So 80 plus 40, 120. So your profit before tax is 120. What is your tax rate? 50%. So 60 is going to be your net profit. Now it is simple. Net profit margin. How is net profit margin calculated? Whenever we talk about profitability ratios, always your denominator will be sales. Got it? So net profit upon sales. So net profit is 60 divided by 720. Return on assets. So if you see the asset, return on asset will be equal to your total liabilities. So an investment is planned for 800 lakhs. So the amount that you are going to raise, 400 lakhs from equity share capital and 400 lakhs from bank loan, is going to be invested elsewhere, that is in fixed assets for the production sake. So your total assets is same as your total liability, which is 800 lakhs. So return on assets, that is return on 800 lakhs. Got it? So it's once again 60 by 800. Return on equity 60 by 400. Okay? Asset turnover. So whenever we talk about turnover ratios, it is going to be sales upon, and it's going to be in times. When we talk about returns, it will be in percentages. When we talk about activity ratios, that is the turnover ratios, it will be all in times. So asset turnover. So what is your sales in this case? 720. And what is your asset? It is 800. 720 by 800. Then coming to inventory turnover ratios. So under inventory turnover ratios, we are going to take only the that is inventory turnover. So cost of goods sold. So cost of goods sold, if we see here, direct cost is 480. Yeah. But inventory turnover they have just worked on based on the profit, gross profit itself. Gross profit divided by 720. 240 by 720. That is 50% of what is material cost. So 480, 50% of 480 is 240 divided by, that is your material cost, inventory, divided by the inventory asset. So inventory turnover. So they have taken 720 because we don't have information about our average inventory. Got it? So that way it is calculated. Are you able to understand these simple ratios? So according to the availability of information, your ratios is going to change. So everywhere please put the formulas and then do the calculations. Got it? Yes or no? Any doubts? Okay.
No, ma'am. Clear.
So then let's move on to the theory part once again. Or let's do illustration 5. Even this is interesting. Okay. These are all some straightforward things. It's not like too much complicated. ABC Limited, which is manufacturing consumer products, has two divisions. One is assembling, another one is finishing. So it is like process costing. It goes from assembling, then finishing stage, and the final product is produced. The two divisions operate as cost centers. Present activities and cost involved in the assembling division and finishing division and a year. Assembly division, number of sets assembled is 12,000. Manufacturing of parts including materials is 6 lakhs. Parts purchased from the market is 4 lakhs. Another variable cost, that is welding cost, 5 lakhs. Assembling cost is 9 lakhs. Fixed cost for the unit is 6 lakhs. 25% of the production of assembly division is sold in the market for 300% and 75% is transferred to finishing division at rupees 280. So it's not the entire thing from the assembly division is transferred to finishing division and it is sold out. 25% is sold at the assembly division level itself and 75% is transferred to finishing division. And in finishing division, certain cost will be included and then it will be sold out. See, like painting cost, polishing cost, fixed cost, and then selling price per set is 450. When it goes through the finishing division, it is sold at 450. When it is through assembly division, it goes as 300 per set. Evaluate the following situations. Division assembly has proposed for expansion of their division for an enhancement of capacity by 20% for 20 lakhs. So they are going to enhance the capacity but at a cost of 20 lakhs. It is indicated that there will be no change in the factory fixed cost in the operation of additional volume of job. So the fixed cost of 6 lakhs as assembly division is going to remain the same. Division assembly proposes to maintain the transfer to the finishing division to the existing level and sell additional sets to the market at the present price. So even though they increase the capacity by 20%, the transfer will be what was the transfer last time, the same. Okay, so 75% or the number of sets if you see. So total is 12,000. 12,000, 25% of 12,000 will be sold in the market. 75% of 12,000. So what is 12,000? 75%. 9,000 will be transferred to finishing division. Then a division, so that is the first situation. Second situation, division finishing has proposed for a transfer of the whole of output of assembly division for rupees 280 per unit, and the additional units can be sold in the market at the existing price, which will involve advertisement expenses to the extent of 4 lakhs, and fixed cost in the division will go up by 1 lakh. So already it is 4 lakhs by 1 lakh, so totally it is going to become 5 lakhs. Okay, so these are all the situations and we have got to evaluate. So if you want, you can go through this problem once again and then we start solving. I'll give you 2 more minutes to go through it. Okay, just go through it. Shall we start solving?
Yes, ma'am.
Okay. So number of assembled sets is 12,000. Oh, okay, we have another situation also. Assembly division claims that the transfer rate of 280 is irrational in a sense of undue favor to the finishing division. See, always allocated things, transfer pricing is a problematic area, because while we look at the revenue at the company level, it's all put together, departments put together. But while we see the department level revenue, that is going to affect. So always the transferor will think about a higher price and transferee will think about a lower price at which it needs to be transferred. So that is why there is a clash over here. So, and the finishing division is given the advantage of market price for their products, whereas the assembly division is deprived of that advantage. So the assembly division agreed to transfer the whole of its output to finishing division for rupees 300. So instead of transferring at 280, they are telling that they are going to transfer at 300 all the produce. You are required to give your recommendation assuming the opportunity cost of capital is 15%. So opportunity cost also needs to be taken into consideration. Now coming to, first of all, what is the existing profitability of the division and the company as a whole. So first comes the assembly division. What is your total sales value? Total sales value is 9,000. We know it is going at 280 rupees. So 3,000 is going to go at 300 rupees. So 3,000 into 300 plus 9,000 into 280 will be your total sales of assembly division. See, that is what they have done. Total variable cost of that particular division. Manufacturing of parts including material is 6 lakhs. Parts purchased from the market is 4 lakhs. Welding cost, assembly cost, all these are variable cost. So 6 plus 4 plus 5 plus 9. So 10, 15 and 23 lakhs is going to be their variable cost. So 6 plus 4 plus 5 plus 9. 10, 15 plus 9. Yeah, 15 plus 9. 10, 15, 9, 24. Sorry. Fixed cost for the unit is 6 lakhs for the assembly. Okay. So while we deduct the fixed costs also, we have the contribution, from that we reduce the fixed cost, so we get the profit for division assembly. Got it? Now coming to finishing division. What is their total sales value? See, 9,000 units are getting transferred to finishing division at rupees 280, which they are selling in the market for 450 rupees. So 9,000 into 450. But what are the additional costs that they are incurring? 5 plus 1, 6 lakhs is going on the basis of painting cost and polishing cost. And while you look at the transfer cost, which is 280 into 9,000, all these things will form part of their variable cost. So did you understand how this transfer cost is becoming a part of its variable cost? Because that is the cost that is paid by the finishing division. Got it? Any confusion over there? Are you all okay? Yes. So then we have a fixed cost of 4 lakhs. Then if we see the performance, profit for division at the finishing level is 5 lakhs 30,000. So individually if you see, assembly division is making 4 lakhs 20,000. Finishing division is making 5 lakh 30,000. Put together, the overall profit of the company is 9 lakh 50,000. So far so good? Are you able to understand till here? Yes? Okay. Then what was our first proposal? First proposal is, the assembly division is telling that they are going to go up 20% of capacity, but still the transfer will remain the same to finishing division, that is going to be 9,000 only. So currently what is the total assembly sets? 12,000. If that is going to go up by 20%, sorry, how many percentage are they talking about? Yeah, 20%. So 12,000 into 20%. 1 by 5 of 12,000. $2,400. So already they are giving 3,000 parts that is being sold out at the assembly level itself. So now it will be 3,000 plus 2,400, 5,400 which will be sold out, and the same 9,000 sets are going to be transferred. So that is what is the first thing. It is indicated there will be no change in the factory fixed cost in the operational of additional volume of job. So that is not going to change. Division assembly proposes to maintain the transfer to the finishing division to the existing level and sell additional sets to the market at the present price itself. So they are going to sell at 300 rupees. 5,400 into 300 plus 9,000 into 280. That is going to be their sales value. Are you able to understand? Yes? Any doubts? Yes or no?
How this 5,400 is there?
Yes?
That 5,400, can you please
I am not able to hear you, dear.
again?
Can you just put it in WhatsApp chat, please? Yes? You got to understand? Okay, variable because fixed is same for all capacity level. 5,400 explain. Yeah. So you want to explain me about the 5,400, right? Yes? Am I correct?
Yes.
Yeah. So see, what is their present capacity? 12,000. Okay? So, if I take, I'll just zoom in. So present capacity is going to be 12,000. What is that they are asking us to do? They are going to increase with an additional capacity of 20%. So that means 12,000 into 20%. So totally they are going to have 14,400 units produced. But out of this 14,400 units, the transfer that they will be doing to the finishing division will be the same irrespective of increase in their capacity, which was 9,000 before and it's going to remain the same this time also. So 9,000 over here. So therefore, what will be sold out in the market? It will be 14,400 minus 9,000, which is 5,400. So the 20% capacity that is getting expanded will be to the direct sales to the market and will not going to anyway affect the transfer to the finishing division. Got it? Am I clear?
Yes, ma'am. Understood.
Yes. So then we come to our calculation once again. So 9,000 they have fixed the price that they are going to sold it at 280 as before. Okay, so this is units and this is rupees. So 9,000 into 280. Of course, they are also not going to change the market price at which they are going to sell. So the market price at which they are going to sell is 12,000, 6 lakhs and 300 rupees. That's also going to remain the same. So if you see, this is going to be their total sales value. 41 lakhs 40,000. Got it? Yes? Yes, Anu, got it? Yes. So now this is the sales value. This is the first proposal, okay, of the assembly department. Next comes the variable cost. So variable cost, we know it is going to change according to the output. Fine. So what is your variable cost? It is 24 lakhs. It was 24 lakhs at 100%. But now is this 100 or 120%? It is 120%. So what we are going to do? 24 lakhs divided by 100 into 120, which is 28 lakhs 80,000. Because it's going to change. So now your variable cost is changed. So what is your new contribution due to this proposal? 41 lakh 40 minus 2880, which is your contribution. Now coming to your fixed cost, as such they have told that there is going to be no impact on the fixed cost, which is going to remain at 6 lakhs itself. Okay. What else they have there? You are required to give your recommendation assuming the opportunity cost of capital is 15%. So whatever you are going to invest for this particular thing, that is going to have an opportunity cost. See, this will not be forming part of your cost statement. This is your decision making process. That is why you are including your opportunity cost. But as per the costing records, we are not supposed to bring in any opportunity cost. Be clear about that. Got it, Anu? From the concept side?
Yes, ma'am.
Yeah. So opportunity cost, for this increase of 20% capacity, how much investment is expected to be done? By 20% for 20 lakhs. So on that 20 lakhs, if invested elsewhere, will fetch you 15%, which is your opportunity cost. That is the cost of benefit foregone is 3 lakhs. So then comes the profit for the assembly department. So over here it is 12 lakh 60 minus 6 lakh minus 3 lakhs, which is 3 lakh 60,000. Got it? This is proposal, first proposal. We are still in the first proposal. Okay. Now what happens to the other department? That division is not going to incur anything. It's going to remain the same. So earlier whatever was the profit, it is already calculated, right? 5,30,000 will be profit for division finishing, because this first proposal talks about only assembly group. It doesn't talk about anything on the what is that, finishing group, because that is not going to, means there is no change in the units also, that's going to get transferred. So over here, profit for the finishing department, I am just copying down the thing which is 5,30,000. So this remains the same. So the total profit of the company in the first proposal is going to be 3,60,000 plus 5,30,000, which is 8,90,000. This is the first proposal. Got it? Then we move on to the second proposal. What is our second proposal? Division finishing has proposed for a transfer of whole of the output of assembly division for rupees 280 per unit, and additional units can be sold in the market at the existing price, which will involve advertisement expenses to the extent of 4 lakhs, and fixed cost in the division will go up by 1 lakh. So how is this going to impact? So here, if you look at assembly division, okay, so how many units are they having? 14,400. So after the expansion, the entire 14,400, the finishing division is telling us that we will take this 14,400 for 280 rupees per unit itself. Let it not sell it outside. Okay. So now how the proposal is going to change. So once again, we'll go here. So now what happens? For assembly division, it is 14,400 into 280, which is going to be 40,32,000. So I'll better work it out. Okay. So second proposal, from the assembly division point of view, nothing is going to be sold out. Instead, it will be sold out to the sales to finishing department. So the entire 14,400 units will be sold at 280 rupees per unit, which will be 14,400 into 280. But if you look at variable cost, it is going to remain the same calculation, which is this much. Yes, 28,80,000. So what is my contribution now? So contribution is 40,32,000 minus 28. Now if I look at fixed cost of the assembly division, there is no change, means whatever they have told will remain the same, which is going to be 6 lakhs. And once again, the opportunity cost, if 20 lakhs is invested elsewhere, it is going to fetch you 15%. It's going to remain the same. So afterwards, when you see the profit of the assembly division, it is going to be 11,52,000 minus 6 lakh minus 3 lakhs, which is of course less than 3,60,000. So individually, it is not beneficial for assembly division if they give the entire thing at 280 rupees to the finishing division. But what about the profit for the finishing department? So finishing division, now it's going to change because the inflow is going to be different. So sales of the finishing department, that is sales to the market, entire 14,400 will be sold out at how many rupees? 400 lakhs, 450 rupees per unit. And this is going to be 14,400 into 450, but less. The transfer price of the products from assembly division is going to be 40,32,000 less the variable cost. If you see the variable cost, 5 lakhs, 1 lakh, 6 lakhs is the variable cost. Yes. So 6 lakhs is for how many units? 6 lakhs for 9,000 units. So then what is for 14,400? So 6 lakhs divided by 9,000 into 14,400. You should be very careful while you calculate the total for variable cost, which is 9,60,000, which is the variable cost. So put together, it is 49,92,000. Can be shown, which will involve advertisement expenses to the extent of 4 lakhs. Okay, advertisement expenses are also there. Okay, which is going to be 4 lakhs. And fixed cost will be 5 lakhs. Yeah. $14,400 into 280. But why have they not given the impact of variable cost? They should have given, because painting cost and polishing cost will go up. Have they mentioned anything about it? I think that is one of the mistakes that has been committed in the book, because we take painting cost and polishing cost as variable cost. So it was 6 lakhs for 9,000 units. But what will be in case of 14,400 units? So I think this is the correct one. Do you agree? Are you with me?
Yes, ma'am.
Yeah. So I don't know why they have not taken. So then comes the contribution. So it will be sales to the market minus their transfer price minus this one, which is 14,88,000. From there goes the fixed cost. So fixed cost is going to go up by 4 lakhs plus 1 lakh, 5 lakhs, less what else? Fixed cost will go up by 1 lakh, and advertisement expenses, which is going to go up because they are going to sell more products, which needs 4 lakhs. So if you see over here, minus, sorry, 5 lakhs minus 4 lakhs. 5,88,000 is the profit for the division finishing. 5,88,000. So since they have not given the impact of this, okay, profit of the finishing division. So entire profit of the company, total profit of the company is going to be 2,52,000 plus 5,88,000. See, in the first proposal it comes to 8,40,000. In the first proposal it is 8,90,000. Whereas in the second proposal it is going down 8,40,000. Okay. Yeah. Since they have not given the adjustment of variable cost, that is an impact on the answer. Okay, and then we have the third proposal. So you can take the third proposal for practice and do calculate the profit of the company. Be careful while you do the adjustment for the variable cost. Please give the impact of the number of units, if it is gone up or gone down, fine. And fixed cost remains the same unless and until they mention that there is a impact of fixed cost. Okay. So can you take that for practice? And then in our next session we will compare all these 3 decisions and then write our conclusion. Okay. So that's all from my side for today. Hope it was an interesting one. Okay, I will anyway post this particular worksheet in the Google Drive so that you have the reference of whatever workings we have done. Fine. So thank you all. Good night. Yeah.